Most people think the moment they reach $100,000, money stress disappears. It doesn't. Instead, something much more interesting happens. $100,000 doesn't make you wealthy. It changes how financial stress feels. Many people say their first $100,000 mattered more than their second, or even their first million. It structurally alters how fear interacts with your bank account. Today, we break down the transition from emergency survival to quiet leverage, and why $100,000 functions less like luxury and more like a tactical shield against panic. Assume you have zero savings. Every flat tire becomes a crisis. Every medical bill pushes you toward debt. Financial stress becomes acute and physical. Now, assume you have $100,000 in liquid savings and accessible investments. Your boss is still difficult. Inflation still exists. But the stress transforms from short-term panic into long-term resource management. The trap is believing a number fixes your emotional relationship with money. It doesn't. Without changing your system, anxiety simply follows you to higher balances. Sarah was a project manager in a mid-sized city. 6 years ago, her car broke down and the repair bill was $850. She only had $400 in checking and a maxed out credit card. That repair triggered arguments, forced food compromises, and months of high interest debt. The bill didn't just damage her car, it damaged her entire week. Financial stress at that stage was not theoretical, it was an immediate threat to daily survival. Years later, after eliminating wasteful spending and automating savings, Sarah reached $100,000. Then her HVAC system failed. The replacement cost was $7,500. Previously, that expense would have been catastrophic. This time, she calmly gathered quotes, chose a contractor, and paid from savings. She felt annoyed, but not terrified. Her relationship remained intact. Her sleep was unaffected. The problem became an inconvenience instead of a financial disaster. The $100,000 threshold did not make Sarah rich. She still worked, drove the same car, and watched prices. But the difference was operational. A major expense became manageable. The shift from survival mode to stability is really a shift in internal pressure. When living paycheck to paycheck, your financial horizon is measured in days. With substantial reserves, your horizon expands into months and years. You stop managing emergencies and start managing systems. Your brain is built for survival. For years, it learned that money must be protected urgently or spent quickly. Crossing six figures does not automatically switch off those instincts. You must retrain yourself to recognize that the emergency phase has passed. Many people continue behaving as if every bill is a threat, even after building meaningful reserves. Stability requires psychological adaptation, not just account balances. When Sarah only had a small emergency fund, she could survive a short disruption, but lacked flexibility. At $100,000, she gained options. If her company became toxic, she no longer had to tolerate every decision. She could search for another role, negotiate from strength, or leave on her own terms. The real value of six figures is not luxury. It is time. It is the ability to make decisions without immediate financial desperation. The value of $100,000 depends heavily on location. In expensive cities, it may be a modest buffer. In lower-cost regions, it can feel substantial. Regardless, it represents operational capacity rather than wealth. The first audit rule addresses fear and greed. Keep emergency reserves in a high-yield savings account and automate the rest into diversified index funds. Separate operational capital from structural capital. Stability comes from allocation, not from letting cash sit idle. Optionality means having the right but not the obligation to take action. Without money, options disappear. You accept the first job, tolerate rent increases, and accept unfavorable terms because you cannot absorb risk. Money expands your choices. It gives you breathing room to evaluate opportunities instead of reacting to pressure. Optionality is one of the most valuable assets six figures creates. After reaching $100,000, Sarah's department received a new micromanaging boss who demanded constant after-hours availability. Years earlier, she would have complied from fear. This time, she stopped answering emails after 6 p.m. and maintained clear boundaries. She understood she could survive without the job for an extended period. Because she had leverage, she remained calm. Ironically, her manager backed off. Money purchased workplace sanity rather than luxury. Financial scarcity often fuels impulse purchases because spending provides temporary emotional relief. When you have substantial reserves, the urge changes. You know you can afford the item, which removes the need to prove anything. Waiting becomes easier. Delayed gratification becomes natural. The danger appears when people use their new stability to justify higher recurring expenses and slowly rebuild financial dependence. The next trap is subscription creep and lifestyle drift. Small recurring expenses seem harmless once your balance grows. The fix is simple. Audit recurring expenses every 90 days. Print recent statements, identify unused services, and eliminate them. Protect optionality by keeping your operational baseline lean. Wealth grows faster when fixed expenses stay under control. The first $100,000 feels painfully slow because it is powered mostly by labor. Assume you save $10,000 annually and earn 7%. The first year generates only $700 in growth. Your effort contributes far more than your capital. Reaching six figures often takes years of sacrifice and consistency. During this phase, behavior does almost all the heavy lifting. At $100,000, a 7% return produces $7,000 annually. Suddenly, the portfolio begins contributing meaningfully. You are no longer pulling the sled alone. The money starts working alongside you. Growth becomes visible. Compounding shifts from theory into reality. The account balance begins increasing by meaningful amounts without requiring additional sacrifice. After a strong quarter, Sarah's portfolio grew by $4,500 without additional contributions. That was the moment she understood assets producing assets. Her savings were no longer dormant cash. They were productive capital generating future capital. This realization changes behavior. Investors stop chasing miracles and begin respecting consistency. The danger at six figures becomes impatience. Large balances make daily market swings feel significant. Investors begin checking accounts constantly and overreacting. The fix is limiting portfolio reviews to a fixed schedule and automating reinvestment. Delete investing apps from your home screen and review balances quarterly. Protect progress by reducing emotional interference. The $100,000 threshold acts like acoustic foam for your mind. Financial emergencies become less noisy. Decisions become calmer and more rational. During a market correction, Sarah watched her portfolio fall from $105,000 to $93,000. Years earlier, she would have panicked. Instead, she understood her emergency reserves remained intact and simply continued living her life. As stability grows, external validation becomes less important. You stop buying things to impress coworkers and stop chasing status symbols. True status becomes security rather than display. The paradox is that people with greater financial options often live simpler lives because they no longer need purchases to mask insecurity. Confidence creates a new trap. People stop monitoring cash flow because they feel safe. Hidden spending leaks begin accumulating. The solution is simple automation. Set spending alerts, review major charges, and maintain basic awareness without obsessing over every dollar. Confidence should not become complacency. Many people hit $100,000 and immediately upgrade their lifestyle. They finance expensive vehicles, move into premium housing, and increase fixed expenses. What appears to be success often destroys momentum. Every new recurring bill diverts money away from compounding. The six-figure shield gets melted down to purchase consumer ornaments. The fix is a mandatory waiting period. Before upgrading housing, transportation, or major recurring expenses, wait 6 months. Write down desired upgrades and revisit them later. Most emotional decisions fade with time. Delaying structural changes protects long-term momentum and prevents impulsive lifestyle inflation. Money amplifies existing habits. An anxious person with $100,000 may worry about inflation. At $200,000, they worry about market crashes. At $500,000, they worry about lawsuits. Sarah's colleague Michael had $150,000 invested, yet constantly compared himself to wealthier friends. Wealth is not a competition, it is a private utility. Balance alone cannot solve emotional scarcity. Money also cannot solve weak boundaries. If family members constantly request bailouts and you cannot say no, capital leaks away. Financial peace requires separating self worth from net worth. Your first $100,000 is a tool designed to create safety and rational decision making. It is not an identity, it is operational equipment. Six figures rarely buys visible luxury. Instead, it buys invisible advantages: time between jobs, flexibility during career transitions, confidence during emergencies, negotiating power in professional settings, and patience during market volatility. The person with a flashy car and no savings serves their cash flow. The person with a six-figure backstop owns their time. The true value of $100,000 is not the money itself. It is the system required to build it: discipline, automation, and emotional control. This week, automate savings into a high-yield account. This month, eliminate recurring expense leaks. This year, protect your savings rate and keep fixed costs stable. Wealth begins when emergencies stop feeling life-altering. What amount would make you feel financially safe, and what specific stress would it eliminate?